And I say that in jest. It's watching the two of these guys speak is like watching, boxing, the sweet sport, isn't it? Because each of them have got a different perspective on the market based on what they've done. So I'm going to let Sean get up here. We're going to have Sean do a presentation, and then we're going to put Sean up here on the chair, and we're just going to interview him about what he talked about. So I'm going to be taking notes during this presentation. Hopefully all of you will too. Let's get Sean up here, Foreclosure Radar.
Thank you. Test. Yeah, we're going. Well, thank you very much for coming out, and looking forward to this. Let's see if I can get this all working. So what we're going to do is I'm going to fly through 30 slides. I'm going to try to do it in like 30 to 40 minutes. So I'm going to go really fast, but we will have time. He said, Sean's promised me that he's going to follow up on anything that I went too fast on, and then we'll have time for questions as well. So I'm going to do a quick market update, pretty high level, what's going on with foreclosures, and then talk about the foreclosure myths, because I think these are having a pretty negative impact on legislation and other things. And, it's kind of my contrarian mindset. I just, hopefully some of them will make you think a little bit, and hopefully a little bit differently about foreclosures. My take on where we're headed right now, and then a very brief just introduction to Foreclosure Radar for folks that aren't familiar with it. So the big picture on foreclosures is, as you can see from the two arrows, the green arrow is starts or notices of default, which is the beginning of the foreclosure process. They've been headed essentially down since March of 2009. And foreclosure sales have been dropping since September 2008. And that's been pretty consistent, and it continues to go down, and I believe it will continue to go down. And I think the reason for that is pretty straightforward, and is largely centered around Hank Paulson's announcement of TARP back in 2008. And most people think about that announcement in terms of loans to the banks, which they've now supposedly repaid. But there was a much bigger piece to that announcement. Part of it was that the Fed was going to jump in and start buying mortgage-backed securities. And that's really the only reason we have an operating housing market at all today, is the Fed jumped in and basically rescued the housing market, and that's the reason you've been able to get loans on deals, or when you flipped a deal, that those folks have been able to get loans. The other things that happened in September 2008 is they instituted mark-to-model accounting. And basically, Paulson came out and said, look, we shouldn't force these banks to sell these properties at these distressed prices. We should wait until prices come back and let them sell them then. And we shouldn't, hurt the bank's ability to pass solvency tests by marking these things down to market. Let me just explain this a little bit. So, real typical deal here in California is you have a $400,000 first mortgage. The home's now worth $250,000. Prior to early 2009, the bank would have to write that loan down from $450,000 to $250,000 on their books. The homeowner doesn't get that, of course, but they'd have to write that down on their books. And that would have created a lot of losses and other issues that would have affected the bank's solvency. And so they rushed this rule through right before all the solvency tests. Remember the banks were doing solvency tests kind of mid-2009? And so what mark-to-model accounting lets them do is they say, well, we really aren't going to default on all of these things, and even some of the folks that aren't paying will end up paying again. We'll come up with this fancy model that says instead of a 40 or 50% loss, it's a 5% loss. And then we get to change our loan loss reserves, right, to say it's only going to be a 5% loss, and that helps us maintain solvency. And in fact, a lot of the bank earnings the last couple of years, if you dive into them, you'll find, oh yeah, Bank of America just reported great earnings. Well, it's because they adjusted their loan loss reserves lower. And when they adjust their loan loss reserves lower, they get to move that over to the other side, and woohoo, earnings are up. And it's all just game, right? So pretty important, and it really changed. You hear this all the time. It's one of the foreclosure myths. I didn't put it in the foreclosure myths part, but the banks want to foreclose on people. And it's just absolute horseshit. Right? They have no desire. They'd leave those things sitting, and they leave you sitting in them forever, not paying if they could. It's fine with them. They're now servicers, so they're just taking a fee to let you sit there, and it only hurts the investor in the pension fund or whatever down the road. The other thing is right at that point in time, FDIC was crippled. They said, let's change the regulations. Before that, 1999s, you get a house, they're not paying. You, as a financial institution, have to move through the foreclosure on the state-allowed time frame, right? You're not allowed to sit and work with the homeowner and all the rest. They changed the regulations and said, sit on these things as long as you want. This gray line right here is the number of properties scheduled for foreclosure sale, right? And it's on the left-hand side, so it peaks around 160,000. The blue line, which is the scale on this other side, so that gray line is really way up there in the ceiling, right? The blue line is foreclosure sales up until this announcement. Notice how they track along perfectly? So you have a certain number scheduled, and a percentage of those go to sale, and it just tracks, and it kept going up and up. And then everything changed in September 2008, and foreclosure sales have been flat and declining since. This only goes through 2008, and then now they're declining, as you saw in the previous. And that's going to continue until those two rules change. So big picture, I like to think about the California foreclosure funnel, because the big question everybody has is, where are we in the process and how much farther do we have to go? We have roughly 8.6 million homes, and I say roughly because we have absolutely no idea, and if you've ever been to the county assessor's office, you know why. We have roughly 6.8 million homes with a mortgage, and I say roughly because if you've ever been to the county recorder's office, you know why. Of those, around 2 million are underwater, according to CoreLogic. 434,000 of the 2 million are delinquent, 168,000 more are in foreclosure, and 65,000 are bank-owned. We're selling about 18,000 foreclosures and short sales a month. Do a little quick math on that, is 667,000 divided by 18,000 is 37 months to go. Now, I've been presenting this slide for about 2 years, and it's been tracking, right? So each month I go back and do the math. Some of the months numbers only update quarterly, and I do the updates, and it's been tracking. So I think this is probably reasonable. Of course, that's only the folks that are already not paying. About 3 years to go. I want to talk a little bit about foreclosure myths, because we all know that foreclosures are evil. They're terrible. They're the worst things that could have happened to our society, and they've ruined our economy, and they're just awful. If any of you have met your local senator or state senator's legislature, you know this to be fact. We have to stop foreclosures at all cost, even if it means throwing away hundreds of years of legal, theory and rule of law. Even if it means taking things through eminent domain, foreclosures must be stopped. And I think that that's based on a handful of what I call foreclosure myths. Now, I don't expect everybody in this room to agree with me. In fact, there's some very, very smart people in this room that don't agree with me on a couple of these. Bruce is giggling. But at least hopefully I can make you think about it a little bit and think about whether foreclosures are good or bad for us as a society. And so that's what I want to do just really quickly. So the ones I'm going to talk about is foreclosures cause price declines, right? Most people believe that. They cause neighborhood decline and blight. You hear that all the time. It's part of the reason that they're pushing for eminent domain and the Homeowners Protection Act bill that just got passed up in Sacramento. They're hurt homeowners. They hurt the economy. And, oh, by the way, my favorite myth, you better watch out. There's a foreclosure wave coming. The latest one is after the election. So on foreclosures cause price declines, I'd ask you to take another look at the housing bubble, because I actually don't think there was a housing bubble at all. I think we had a credit bubble. And let me just explain this chart real quick. This top line is price, right? The median price in California. In 2000, it was 250,000. At the peak, 2007, it was 550,000. That was the median price, right? The average home sold in California. This line right here, $50,000 up to 60-something, is household income, right? So household income fairly flat, increased a little, but fairly flat over this period of time, right? So it's not, people weren't getting rich and buying bigger houses. It was about the same. This bottom line here is rents, you know, kind of slowly increasing along with inflation, kind of what you'd expect. And I was thinking about this run-up in prices and how did this happen? You know, Robert Shiller, a famous economist, wrote this book, Animal Spirits, right? We all just got a little crazy. But, I wasn't buying it. Certainly there were some folks that were crazy, but do we all get that crazy? And I said, let me do this. Let me look at the most aggressive but popular financing options that were available each year. And so what I did is I took the median household income and took kind of the most popular but aggressive financing option each year, and I took the median income and the median price and I calculated payment. That's this yellow line. You notice it's flat, or pretty much flat? So here's what we had happen. We had buyers do what buyers have always done, which is buy as much house as their bankers tell them they can afford, right? There was no bubble in buyer behavior. Buyers did what they always have done, bought as much house as their banker told them they could afford. I think that's worth repeating. So if you remember in 2000, folks like myself in Silicon Valley caused this big dot-com bubble. I went out, raised $120 million with a couple of friends for a company that we ended up selling for $10 million, and it wrecked the economy. And, Alan Greenspan, in his infinite wisdom, decided to rescue us with a zero interest rate policy. So as interest rates go down, right, on a certain income, as interest rates go down, I get a lower payment. No, I don't get a lower payment because I buy as much house as I can afford, so I spend the same amount of money and I spend more on a house. Do I get more house for that money? No, because everybody can spend more for the house, so prices go up. And then we get the 5-1 interest-only ARM. I don't know about down here, but in Silicon Valley, you weren't cool if you didn't have a 5-1 interest-only ARM, right? You couldn't show up for dinner without a 5-1 interest-only ARM. That was the only way to roll. Then, right, they started to loosen up debt-to-income ratios and all the rest, and then you get the mother of all financial devices, the negative equity or amortization pay option ARM, right? Not a lot of time, but when do people think the pay option ARM was first introduced? Would it surprise you to hear the 1970s? Would it surprise you to know that the pay option ARM was introduced to lower delinquency rates and lower foreclosures? Because here's the way the pay option ARM worked until this period of time. They qualified you for the pay option ARM at the worst payment, not the best payment, at the standard 30-year payment, right? And then if you ran into a little financial trouble, you could temporarily use the option payment, right, to get through that hard period of time without becoming delinquent and add a little negative equity, but it was fine. But they qualified you at the big payment. The mistake here wasn't having negative AM pay option ARMs. It was qualifying people at the option payment, the lowest possible payment. But what we're going to do now is we're going to over-regulate and throw out that financial product, which was a good financial product as it was originally used, and we're never going to sell another pay option ARM ever because it got misapplied. So anyways, pay option ARM gets us up to that 550, right? And I saw this. I was selling houses in Stockton. I was selling houses to, the farm worker and a maid, who had a household income of $40,000 and they're buying a $350,000 house. And that's in 2005 when I decided to get out of the market and sell all of my real estate, except for my personal house, which was an emotional decision, not a financial one. And so I got out and I started watching foreclosures and started watching what was going on. And what was interesting was in 2006 in Stockton, the median price was going up. which was pretty interesting because to me it seemed like prices were starting to decline across the board. The reason is they stopped doing loans to the subprime folks first. And the high end of the market kept going. And so one of the things, most important thing you need to know when you're looking at median prices in the newspaper is they don't tell you the change in price. They tell you the change in mix of real estate. So what was happening in Stockton was the high-end neighborhoods were still selling because prime loans were fine. Those were never going to go bad, right? And they were still making those, but they weren't making the low-end loans. So the only stuff that was selling was higher end. So if you had lower-end stuff selling, now you have higher-end stuff selling. Even if this stuff is down in price, your median price, your mix of homes, moved up. So median price in the newspaper went up. People thought things were okay, and they weren't. When we finally really saw prices drop everywhere, right, was after all the foreclosures, right? I don't think so. It was after we returned to traditional lending, right? Once the loan programs went away, because guess what? People still did what they've always done, which is buy as much house as their banker told them they could afford. There were fewer stooges in the end when things started to look a little rocky, right, that were doing that, but people were still doing it until those went away. So what caused price declines was the same thing that caused the price increases, changes in lending terms and changes in what bankers told buyers they could afford. Now, I won't argue that foreclosures played a role because banks are a willing seller. At least they used to be, and especially in 2008 when the law said you have to go through the foreclosure process and you have to sell this home. Before Paulson stepped in, which was a little too late on that front, right? The bank was the willing seller. So whereas everybody else said, geez, my house was just worth $500,000, I'm not selling it for $250,000. Banks said, well, we have to sell it for what buyers can afford, and that's $250,000. And so they became the first sale. But that doesn't mean they caused the price decline, right? If they hadn't created those sales, guess what would have happened? Nothing would have sold. Does that make sense? And we wouldn't have seen sales again until prices corrected. Now, would prices have fallen as far without foreclosures? I'm certain in some areas, perhaps not. You know, that's probably a reasonable argument, but they weren't the cause. Does that make sense? Next one, foreclosures cause blight. You know, this is a big one out there right now. And, you know, I personally take a lot of offense to this because I've purchased and fixed up 150 foreclosures, right? This is 150 homes that I put new granite countertops in and new carpet and painted and scrubbed and cleaned up maggots and all kinds of other stuff that you get to find in these homes. And the idea that foreclosures cause blight is, you know, seems a little nutty to me. When you actually have a foreclosure and it sells, that's when it gets fixed up and taken care of, right? It's the underwater homeowner that has no incentive to make repairs anymore that causes blight. And we're choosing right now in our policies to keep people in their homes longer and longer and create more and more blight. They're feeling this in a big way in Nevada right now, because in Nevada, they've essentially made foreclosing illegal. And, you know, so short sales are ticking up, which is a good thing. But I'm just going to roll through really quick. We'll take questions later. But, you know, the Attorney General that really pushed to get that through got lambasted in a meeting because all these neighborhoods are starting to decline and deteriorate. And their office called me because I had lambasted them in the paper, and they said, well, we don't understand. Well, why isn't this a good thing? And I kind of walked them through, look, an underwater homeowner's not going to fix it up. We actually have, I live now in Truckee, which is really close to Reno. This last winter, there was no good skiing because the snow was terrible, so we all played ice hockey. And on my son's little hockey team, one of the moms and I are talking, and she says, you know, we haven't made a payment, I think, in 3 or 4 years. And we're getting kind of upset about it. And I said, upset about what? And she goes, well, we thought they would foreclose right away. We want to move. We don't like the neighborhood we're in. We want to move. And we can't move. And we can't get our credit repair started. And this is really messing with our life. And I said, that's a good point. I said, well, you know, The contract you signed says if you don't make payments, they have to foreclose. That was the deal. And that's the deal, the way it worked up until September 2008. She goes, well, do you think I can sue the bank to force them to foreclose? I think it's a great idea. Non-paying homeowners typically stop paying their taxes as well. Now, for all those folks that had escrow accounts, which the banks really pushed for, the banks have been kind of making the property taxes because they don't want to take the risk of losing the home. So it's not, there hasn't, I was actually surprised. We started pooling lists of properties in foreclosure to see if they were paying the taxes or not. More were paying than I thought we would find. But, certainly the folks that didn't have escrow accounts, usually when you stop making your mortgage payment, you stop making your property tax payment as well. So for those who say foreclosures cause blight, I would say not foreclosing is far worse. Foreclosures hurt homeowners. Again, I've bought 150 foreclosures. I've had to walk a lot of folks out the door in evictions and the rest. Usually after a period of time, it can be pretty traumatic to lose your home, go through that, have to move, all the rest. Certainly that's not fun, and I'm not saying otherwise. But inevitably, going from being $200,000 upside down to, being free and clear of that, lifts a lot of emotional and otherwise burden. And the foreclosures aren't what hurting the homeowner, right? They were hurt by a dramatic drop in price after a dramatic bubble, right? It wasn't foreclosure that was the cause of the problem. It was a credit bubble that was the cause of the problem. And why our legislature and the rest can't get their mind around the fact that the real problem here is negative equity, right? And foreclosure is a solution for that still is beyond me. If you're going to be foreclosed on, California, out of every place in the world, is the best place to be foreclosed on, period. I mean, there are countries where that debt passes on to your children, or you go to jail, or, it's awful in some places in the world, and even most places in the United States. They're full recourse loans. They get to come after you and hound you and push you into bankruptcy. There are cases, with HELOCs and refied seconds where you can still have a little trouble here, but by and large, you get to walk away without much issue in California with a little hit to your credit. And, we've got one of the most progressive states on the planet on that front. And I won't argue that principal balance reduction loan modifications and short sales are better for homeowners. I think they are. But foreclosure here is still a great deal. The one big question I have about principal balance, reduction loan modifications and that kind of thing is who's going to pick up the tab, or even of eminent domain, right? Because you force that through, you force those losses through and the rest, and you get that principal balance reduction done. That's a $2 to $3 trillion loss nationally, right? Are we ready to add that onto our national deficit and all of those making our payments? Are we ready to pick up that tab, right? Are we ready for our pension funds to take those losses? Are we ready to shut down our financial system in order to do that? So, all the folks out there arguing for principal balance reductions, I just have one question. Are you going to pay for it? Now, that's going to happen regardless, even if we have foreclosures or whatever, but, it's easy to have a pie in the sky, the government should fix it mentality, but we are talking about real money. And I think that's why instead we have a policy of extend and pretend, right? We have what I call negative equity denial, right, as a nation. We're just going to ignore it until it goes away. Foreclosures hurt the economy. How many people here have made money on foreclosures? Has it hurt your economy? It creates jobs. Agents, investors, title companies, loan officers, attorneys, contractors, more. Imagine we didn't have foreclosures and banks as willing sellers in 2008, 2009, 2010. How many more job losses do you think we would have had? Right? Think about all the economic activity that 40,000 foreclosures a month going through, all of the people, the inspections and all the rest, sometimes going to an auction investor and then back through somebody else, and the rehab and the painting and all. It's a lot of economic activity. Our customers buy $500 million to $1 billion worth of property a month on the courthouse steps, cash. That's some economic activity, and that's just in California. And past homeowners, right, they now become renters, often from local investors, right? How many of your tenants are past foreclosure victims? At least half, right? So, and that's income now coming into local pockets rather than being sent to mortgage-backed securities, and God knows where that goes. And property taxes get brought current after foreclosure. So if they are behind, right, the new owner comes in, the first thing you have to do is pay up the property taxes. I don't understand how foreclosures hurt the economy. They've created more economic activity in California than any other thing. They've been our growth industry. My favorite, watch out, the foreclosure wave, it's coming, right? Every month I get that newsletter from an unnamed company. Subscribe now. It's here, it's time. Look, the shadow inventory is real. The math here is wrong because I'm double counting on some of this. The delinquent is included in the underwater, so it's really 2 million. I caught that last night. But so it's a little less than 12 years. We got a lot of folks underwater, right? We have still almost 30% of Californians, I think it's 27 or something is the latest number, Californians with a mortgage that are underwater in their homes. I mean, that's a national disaster, the number of people we have underwater. We had $4.5 million of mortgage debt in 2000 on $10 trillion worth of real estate. At the peak, we had $10.5 trillion worth of mortgage debt. Okay, we've had a lot of foreclosures. We cleaned up a lot of stuff. You'd expect that $10.5 trillion would have dropped a long way back towards the 4.5, right? You think at the peak we got to $20 trillion in real estate value. You think we're getting pretty far down back towards that 10.5 at 2000? I think so. Guess how much the mortgage debt's dropped nationally? From 10.5 to 9.8. That's it. We are still so over-levered in our mortgage. And, it kills me. I listen to the presidential debates and the rest, and they talk about, we can fix housing with jobs. I don't see all these underwater folks putting in new swimming pools and roofs and all the things that would create jobs until they're no longer underwater. This is where I say we have negative equity denial, and not to have any candidate or our current president, be at least a little bit honest about that, or have some sort of knowledge of it. Well, do they not have knowledge of it, or are they just explicitly denying? I don't, just avoiding it. I don't know. But shadow inventory is real, okay? But REO activity is dropping. Those 430,000 delinquent folks aren't coming running through the foreclosure process, right? We're down 5,929 homes in August. That was a big jump. It's been about 5,000 a month this year, down from over 10,000 a month last year, right? We had almost 30,000 in 1 month at the peak, right? 230 in Orange County, down 48% year over year in August, right? California's current REO inventory is 65,000. There was a recent report that said only 10 or 15% of REO properties are on the market. There's a foreclosure wave. Watch out. The problem is it takes banks 9 months to resell a foreclosure. How long are foreclosures on the market? Days? A week? So if they were on the market a month, take 1, divide it by 9, because, right, they have to clean it up, they have to evict the folks, they have to go through escrow, all that. Let's see, 1 divided by 9, that's right in, around 10 or 15%. So the banks are doing a really good job. If they've got 10 or 15% on the market, they're doing a really good job of getting these things on the market and getting them cleaned up. And guess what? We see that because that 65,000 number that they currently have in California goes down every month right? They sell more than they're taking in. REOs are going away, folks. And keep in mind, the REOs that sold this month, how many feel like we had a lot of REOs sell this month? No, right? Okay, those were from 9 months ago when we had double the number of new bank-owned homes. So think about 9 months from now, what are we going to have? Half the REOs that we have today. REOs are going away. Not completely. If you're focused on REOs, there's still going to be REOs. They're going to continue for years, right? We got a long way to go, but not at the volumes they were, right? So it doesn't mean you can't be an REO buyer. It doesn't mean that that business is gone, but the volumes are changing radically. REOs are currently 17% of home sales. So as REOs have gone down, short sales have come up. And what's really interesting, remember that slide earlier I said it was about 18,000 a month? So every month I go back and I check that number, 18,000, right? And it used to be almost, well, at one point it got a little bit more, but 18,000 foreclosures and 0 short sales, right? And now, more than half of it is short sales and less is REOs. But it stayed right around 18,000 a month. Feels a little programmatic to me. Right? How does that happen organically or naturally? I'm not going to put on my tinfoil hat, but 18,000 a month distressed sales, and it's switching from REOs to short sales. Haven't seen a change in it yet, not for a long time. Delinquencies, though, are dropping, right? So big picture, we are working our way through this, right? The numbers are going down. Every foreclosure, every short sale, every principal balance loan modification does eat away at that negative equity number, does eat away at the delinquencies. It is getting better. It's not going as fast as it would have if Paulson hadn't stepped in 2008, and depending on where you sit, that could be a good or a bad thing. It's a different market than it would have. Prices made a harder right turn than they probably would have had, mortgages disappeared completely and we had to do cash deals and the rest. But delinquencies are going down, right? Big picture, this stuff is getting better. But bottom line, there is shadow inventory, but there will be no foreclosure wave. There will be no wave of anything, in my opinion. There's no shadow inventory of bank-owned homes. There's not a bunch of bank-owned homes sitting on the sidelines that are suddenly going to get listed. Foreclosures take 291 days in California. Notice it's 368 in Orange County. We actually did a study quite a while ago. It ended up in the Wall Street Journal where we found that lower-end homes, Stockton, San Bernardino, Riverside, get foreclosed on a lot faster than higher-end homes, more like you find in Orange County. And boy, does it show right there. There's definitely some shadow in the delinquencies, but it's still declining. There's a big shadow of underwater homes, but that's a long way from being on the market, right? Delinquent to foreclosure is an average of a year, and then you add 291 to a year on top of that. We're talking a couple of years of notice when these things start to actually move through the pipeline. If we ever start to see shadow inventory or a wave, we're going to know about it probably a year in advance of it even hitting the trustee sales, let alone hitting the market, right? There's no, for those of you, whether you're sitting around waiting for that big wave and you're gearing up for it, you're wasting your time. And if you're like worried that your current holdings are going to get wiped out by this wave, you watch it, but don't worry. Nothing to worry about today. Not likely to surge to market. If it does surge, we'll see it. Okay? So don't believe the myths. Foreclosures are improving, but we have a long way to go. Shadow inventory is real, but a long ways off. There is no wave of foreclosures on the horizon. Foreclosures aren't the problem. They're part of the solution. So that's my contrarian take. Where are we headed? The current anti-foreclosure forces and negative equity denial will ensure a stagnant economy for years to come. Woo! You just can't have this many people sitting underwater, not spending money, not doing what they're supposed to be doing, and have a great economy. And hopefully someday somebody in Washington figures that out and figures out, we gotta start ripping the Band-Aid off a little faster if we want to get the economy going again. So I expect fewer jobs, more blight, less tax revenue, and longer recovery. How's that for positive? The most important thing you need to understand as a real estate investor today is price no longer matters. Comps no longer matter. Yield is where it's at. And by yield, I mean kind of simple ROI, not the ROI calculators that calculate in appreciation and all that other stuff. I'm talking about the basic bottom line, income minus expense divided by investment, simplest form of ROI, right? It's the income return on investment that you can get from a property. Notice that we've all heard about the private equity firms coming in, right? Okay. So let me explain just big picture what they're doing. They're buying yield. They're not buying price. They're going to buy it this yield. They're going to package it up into a real estate investment trust and sell it at this yield. Okay, so let me just walk you through that really quick. Right? So you can flip this equation around with a little simple algebra, and you get investment equals income minus expense to ROI. So if we say rent's $2,000 a month and expense is $4,000 a year, $20,000 just so I can do simple math here in my head. So income minus expense, $20,000 divided by the ROI being the percentage return we want, right? Just like you'd compare it to the yield on a CD or on a savings account, right? So at 10% ROI, that property is worth $200,000. Does that make sense? At a 7% ROI, that same property is worth $285,000. If I'm buying on yield, sales comps and none of that matters, right? I want a certain return on my money. If this produces $20,000 a month and I want a 7% return, I'm willing to pay $285,000. If I only need a 5% return, that property's suddenly worth $400,000. Okay? The private equity firms are buying up everything they can at a 7 cap. They're going to package it up and they're going to take it public at a 5 cap. Cap rate's the same thing, right? This is simple analysis. You may also have heard of a cash-on-cash return. That's when you start factoring in financing and subject to, and how much money did you make on your cash, and if you put zero down, you got infinite returns, right? But this is assuming that you paid cash for the property, right? So if they buy these properties at $285,000, and they can package them up and sell them in a REIT with a 5% yield, people aren't going to go do the comps on every property, right? They're just selling yield. They get $400,000 for each property. That's a $115,000 difference. So they just bought a bunch from Fannie Mae, and it's a structured asset deal. And what that means is Fannie Mae is going to finance it. So they're going to run around and buy up properties at $285,000. Never mind that they're only worth $200,000 today, right? They're going to run around and pay $285,000 for them, which Fannie loves because they're getting $85,000 more than they would have out using sales comps, right? But Fannie's going to finance them. We haven't heard the exact terms, but I think it's maybe around 90%. So they're only going to come up with $28,000 themselves, right? They're going to package them up and sell them for $400,000. Now, they've promised Fannie they're going to share a little bit of that increase, right, with Fannie. So, okay, so maybe 80 of it's there. So they're going to make 80 on their 28, and they're going to try to do that in less than a year. That's what the private equity firms are doing. Now, there's a big question in my mind here, right? So we've seen places suddenly start to rapidly appreciate to a 7% return, right? So places where you used to be able to get a 10% 10 cap deals out in the market, they're suddenly disappearing because these private equity firms are coming in and they're pushing up prices, and people are going, these prices don't make any sense, I don't understand what they're paying. I've had these guys say, I will pay double what the property's worth so long as I get my 7%. I don't care what it's worth. I care about yield. The question is after they buy all these up and then the REITs are formed, and the REITs are going, well, we want more properties at a 5% yield because we have lots of people investing in our REIT if everything goes well, and the Federal Reserve is giving them a gift of keeping a zero, interest rates at the zero bound, right? So people have no place else to put their money, so they're going to put their money in property that's really only worth $200,000 that they're going to pay $400,000 for because this REIT is safe, and I'm investing in single-family real estate, which only goes up. Especially when you buy it at the bottom, like right now, right? It's a bottom. And I'm getting a 5% yield, and I bought real estate at a bottom. I don't think it ends well, but it's a pretty interesting trend to think about. Boy, if they pull this off over the next year or 18 months or however until it doesn't end well, does that create some opportunity for folks in the room? I think it does. Now, I think that there's also a lot that could go wrong here. Would I be out running around buying up stuff at 6% to hope I'm going to get to sell it at 5%? Absolutely not. But if I was buying north of 7 right now, and definitely if I was buying north of 10, I'd buy up everything I could and be ready to sell it. Because I think what's going to happen is these guys, if this thing goes and they're able to package this up and sell it as a 5, they're going to want to package up as much as they can. If they can buy your stuff at a 6 and then get a 5, there's still good margin for them for packaging it up. And there may be some real opportunities, especially if you own 50 doors, right? I'll just keep rolling because I think I'm already running along. QE Infinity just announced, right? Quantitative easing. We're printing more money. We're going to print more money in the form of $40 billion a month in mortgage-backed securities. This basically means that the Federal Reserve Bank is going to buy $40 billion worth of mortgages a month using money? No, nothing. They just get to create $40 billion a month in order to buy $40 billion worth of mortgages. And their goal here is to devalue the U.S. dollar. By devaluing the U.S. dollar, they make us more competitive in the world. The problem is currency wars never work, and I know I'm going really fast on this. And other countries then go, well, we have to devalue too, and then everybody devalues and you get inflation, and then you get unrest in the Middle East because people can no longer afford groceries, and it usually ends in world wars and things like that. But we won't dwell on that because that's depressing. Moderate impact to housing despite the rhetoric. Bernanke was on right after he announced this that, this is going to push up home prices and going to push up stocks. Why the Fed thinks their job is to create asset bubbles, I don't know, but that's what he is bent on doing because he seems to think that pushing stocks and real estate up is what will save the economy. I think it's fixing too much debt, not adding more debt, but we have a difference of opinion. Inventory of homes will remain tight. I don't see supply coming from much of anywhere. So if inventory feels tight now, I think it's going to stay tight. I think foreclosures are going to continue to decline. We have too many homeowners that are underwater that can't sell without a short sale. I think short sales and REOs are programmatic, $18,000 a month. We'll continue to get those. Those of you who want to work hard on short sales, I think they will increase as the REOs go down, right? I don't know that REOs will go a lot lower. We're already down to $5,000 a month with a 600,000 property plus backlog. So it seems like it's pretty low already. Homeowners that actually have equity tend to be hunkered down. They're not going, woohoo, let's go out and trade up and the rest. We'll see maybe a little bit more of that as people get comfortable we're at a new normal, or maybe start to see prices rise, or start to worry about inflation and may go, well, geez, I want to be in this school district instead of this school district. Better to move now than later. So that would be one place to look. But the big question right now is where will inventory come from? And short sales are probably one of the brighter spots, or hardworking folks in this room going and knocking on doors and finding folks like Sean found that need to sell for whatever reason. I think prices may rise thanks to this, especially in areas where these private equity firms are operating. I don't know that they're going to rise, in areas that didn't come down as significantly as Inland Empire, Stockton, and some of the other places. But I think especially in those places, any place, do the yield math instead of the price math, right? If yields are above 10%, you better expect that prices are going to go up and maybe up dramatically. If yields are below 5%, expect prices to continue to go down, right? Is kind of the bounds there. Now, when you think about real estate in terms of yield instead of price, right? You'd expect a lower yield on a trophy property on the beach, right? If I'm buying that, I'm probably buying it for ego, not for investment value. And so maybe I'm willing to take a 0% return or a 1% return if it's a really nice property on the beach. So my return expectations there are different than in, I don't want to pick on a particular, I'll pick on an area my way, Richmond, where you're likely to get shot in a drive-by shooting, right? I want 20% plus kind of returns, and even then I'm going to wonder if I really want to do that deal. So returns vary a little bit on the kind of neighborhood you're in. We talk about this 5-7 just because that's where the private equity firms are targeting, but use your head on that. It should vary a little bit depending on the area. So I think that expectation, though, for reasonable ROI will constrain price and will really have a lot to do with where prices go. We're still going to have issues with credit and appraisals and things like that with prices going up real dramatically. So there's going to be some constraints there. I also think there's some constraints on how far you can push up rent. And at the end of the day, rents have been pretty flat over a long period of time and kind of risen with inflation. People can only afford to spend so much of their check on housing. Percentage of renters is going to increase. We still have, an awful lot of folks that aren't making their payments. They're destined to be renters. They will be, I expect at least another 500,000 households in California will convert to renters over the next X years. So that's going to be a growth area. I keep talking to brokerages, and the fastest growing part of their business is their property management area. So we're going to convert a lot more doors to rentals. Private equity firms are going to definitely take some of those, but I think that there's an awful lot of doors that need to be converted. And early foreclosure victims, right? Those poor folks that got foreclosed on and actually let their house go first, or God forbid, strategically defaulted. Guess what? They're all done. They get to come back. They get to buy again, and they get to buy with interest rates at 3.25%. Whereas the poor folks that decided to hang on and do the morally correct thing, even if they start now, 3 years from now, I don't know that mortgage rates will still be at 3.25%. So a little moral hazard there, I guess. So it's important to still watch for the signs. I am predicting that there will be no wave of foreclosures. I've had a decent track record, but I could definitely be wrong. So fortunately there's lots of stats, right? We'll see it in the stats way ahead of time if it starts to happen. We have free stats available at foreclosureradar.com. Just go to Learning Center, Stats and Trends. You can see how many bank-owned homes are in your city, your zip code, whatever. No charge for that, right? How many new REOs were there last month, right? How many new properties entered foreclosure. You'll see months and months in advance what's going on that front, and it's free. And we also have that little orange box on the side for the free foreclosure report sign up. So if you're not good at remembering about coming back, we'll send you a reminder once a month with the new stats and my take on what's going on in the market to remind you to go take a look at the stats. What Foreclosure Radar is all about is we wanted really, really deep search capabilities on the foreclosure data. Most of the search engines allow you to search by bedrooms and bathrooms and price, and that's about it. And we said, well, boy, I'd sure like to be able to search for properties that have a notice of default, and the lender's Wachovia, and there's only one open loan, and it's in this neighborhood, and really deep search so you can focus on your specific farm area or whatever that you wanted to. We track every foreclosure in California, public record notices of default, which is the start of the foreclosure process, notice of trustee sale, which starts the auction process. And then what we do that's really different, nobody else does it on a wide scale like we do, is we track the daily auction results. So we'll tell you about a new REO the day it happens on the courthouse steps, rather than anybody else is going to report the trustee's deed, which gets recorded weeks later. So you can find out about properties that are going to be listed as REOs months ahead of time and start working those deals. We also have really in-depth property information, including like title history, so you can see, wow, this person refied this many times, and how'd they get into trouble. My assistant is amazing at looking at title. She goes, oh, look at this, and then right here they got divorced, and then they probably took out money to buy a new RV, whatever. She could like tell their life history, and then we roll up, and yep, there's the new car, and it's like, okay, yeah, we saw exactly what happened there. So title information is super interesting, and we have a a title history in there. And then we have some business management tools, market analysis tools, more in-depth stats and trends in the product than on the website, and some marketing tools for realtors as well. Lots of additional resources, webinars. There's more in our learning center, like foreclosure guides and stuff. All that's free. And so that's what Foreclosure Radar is about. And bring Sean up, and we'll get rolling. We have a free 3-day trial. It's $49.95 a month. California Association of Realtor members get a discount. Thank you very much.
Oh. You're gold, baby.
Gold, awesome.
All right, what I know a lot of you guys have questions. Write them down. We have some pads of paper over there. Pass them to the center. And the reason we're going to do that is so that I can read it out loud. It can get recorded. It can get broadcast. And you can re-listen to it, right? So that we can get a clear question asked and a clear answer from Sean. So I'm going to start by doing a little bit of an interview, kind of ask him some questions that I have about his presentation. And then I really encourage you guys and gals to write down your questions and get them up here to me. So you are a bit of a contrarian, aren't you?
I try. It's worked well for me.
Yeah, no doubt it has. I think one of the things that I have looked at your software, but it's so even if people aren't doing foreclosures, what I found impressive about it is, like you said, the level of detail that you go into about the searchability. You know, how many of you guys out there, guys and gals, know that certain banks move faster than others? When you go to your site, you're able to search that and say, okay, I only want the stuff from Wachovia or whatnot. Right. And I think that's something that those people that haven't used that a lot understand. I mean, listen, I was in title for a long, long time, and you can get comps from title, but they're just not accurate. And accuracy is important when you're buying this stuff. I mean, clearly. Yeah. So thank you for having such a fantastic website, first of all.
Oh, thank you.
And I'm glad you said something at the end. I'm like, he's not going to say his website is awesome. How many people have you used Foreclosure Radar?
Awesome.
What a following out there.
Yeah,
okay.
That's great.
You got something coming next year. Give it a little, something's coming, right?
Yeah.
Say that. Just say something's
coming.
You must be very, very hush-hush about it, but so it's about a solid 18 months of development. You've been working on something new.
Yeah, that's why, for folks that like, wow, they used to make updates and new stuff every couple of months, and you haven't seen anything for a while. That's why we've been hard at work. There's rumors out there that I moved to Truckee to go skiing, and I'd stopped working, and that's not the case.
Only because there wasn't good snow last year.
Yeah, there was no choice but to work last year.
Exactly.
Snow was terrible. But no, we've been really hard at work. I've actually expanded the team and brought on a lot of new folks and a lot of new developers, and we're really excited about what we have coming, and that's all I'm going to say.
Fantastic. You mentioned a number that your customers are buying at the courthouse steps. Can you repeat that number?
$500 million to $1 billion worth of property a month.
A month. That's to me, that's just and that's California.
Yeah.
You're not 50 state.
No. That's
okay.
Just California.
So $500 million to $1 billion a month in inventory. I want to ask. I don't know if you track it. I don't know if you have conversations with them, Sean. But of the people that are buying that stuff, what percentage are buying for yield, and what percentage are buying just to turn it and burn it?
Yeah, that's definitely changing. Keep in mind, that's only our courthouse steps buyers. So we have a lot of folks that use this for short sale buying and other stuff that's not included in that $500 million to $1 billion. That's just winning bids at the courthouse steps. That really kind of almost depends on the county, right? So you take San Bernardino, Riverside, maybe Kern, Sacramento, where the private equity firms have really come in. We've seen a lot of that, especially the cookie cutter 3-2 kind of deals have pretty much all gone now towards more the rental, right? They're buying them at prices you just can't flip because they're not supported by comps, because they're buying yield, not price. And, it took us a little while to kind of figure that out, because my auction investors are going, wait a second, they're paying more than it's worth. These guys are going to get killed. And then when I realized, wow, they're buying at a 7, and I think they're going to be successful packaging it up and selling it at a 5. I mean, Facebook got out at 38, so why not a bunch of, rental properties? I think it's likely to happen. So, suddenly it all made sense, and yeah. And so there's a good chunk of it going that way. But keep in mind, they're buying cookie cutter deals. So deals with hair on it, older properties, higher end properties, and that's where a lot of my auction investor, customers that aren't these big players buying for yield have gone. Right. Some of them have gone to work for the other guys, right?
Right.
I tell you, we've got a lot of auction investors that say, last year I was making 5% on a deal, right? I'm buying a deal for 200 grand. All said and done, I'm making 10 grand on it, right? 5% return.
All the blood, sweat, and tears.
And I just went to work on my capital, 5% return on capital for all the work. I just went to work for a hedge fund. They're paying me 3% on the deal with zero capital out of my pocket, right? So quite a few of the auction investors that saw this coming and went out and made relationships early got in on it.
Yeah, and I was thinking that would be, these hedge funds may be great up-leg buyers for a lot of us out there that are buying these, and buy the ones with some weirdness on them, and get it to a point where it looks pretty and it's getting that cap, and then, gosh, the higher cap you get it in, you get to take the squeeze.
You get to take the delta. That's
right.
Absolutely right.
Awesome. All right, I'm going to get into some of these questions. Okay. I'm just going to read them as they come. Okay?
Uh-oh.
What? Do boxers or briefs? No. Okay.
Well.
What do you? Is that the new thing on Foreclosure Radar? Predictive
yes.
Underwear sampling.
Yes.
What
absolutely.
do you think will happen to inventory on Las Vegas? That's question one. But I want to read them all out. And do you think AB 284 will be repealed and/or changed? So I guess they're asking, how does our inventory here? Maybe if you thought about how it affects like a Las Vegas, since I think you mentioned that in your presentation about some of these, what's happening in Vegas with how people are just staying in their homes and not repairing stuff.
Yeah. Attorney generals and politicians don't like to admit they're wrong, so I don't really think we'll see anything repealed, but we may see some changes to try to bring back some of that. The Attorney General that I spoke to, Deputy Attorney General that I spoke to, said, one of the major banks told her, there is no way in hell we're going to foreclose on a single property until that law is gone. And, that said, that's not the way it'll work. They'll come up with something to fix it enough that they can come back into the market and feel comfortable. So I think at some point it will. I mean, the Attorney General's office is actively out trying to solve it right now. They didn't intend to stop foreclosures completely. They just wanted to, clean it up. It was kind of their intent. And so, but they got some unintended consequences out of the deal that are worse than, the problem they were trying to solve. I'm not an expert on Vegas. Some of the stats that I've seen out of there have surprised me in terms of, the amount of volume and stuff. I'm not a Vegas guy, so I don't completely get the appeal, but it has appeal for a lot of folks, and, it's still attracted money, and there's still been deals done, and there's some folks that have done really well there. But I don't have any real crystal ball on that one.
Okay. Put another question in here. Okay. Sorry, guys. Some of your penmanship is really bad. My goodness. I should
Mine
give you
too.
guys, word processors or something. Just text me your questions. All right. Is there any difference between the packaging of mortgage-backed securities and the packaging of these projected rents?
REITs.
Okay. Thank you. Seriously, right? Like, that's because you probably wrote it. Will it end similarly to the mortgage market?
So, the thing with the mortgage-backed securities is there's, you get into the tranches and it's complicated. And then there's also the credit default swap. I actually think the problem isn't so much the mortgage-backed securities, but the credit default swaps, that if these things don't pay, that you have somebody on the derivative side. So a credit default swap is essentially insurance but it's completely unregulated. So like when you get fire insurance from a fire insurance company, they're pretty highly regulated. They need to have certain assets. So if there's a big fire, like maybe the biggest one that's happened in the last 100 years, they have enough money in their fund to cover the losses. And the Commodity Futures Modernization Act, which I think that one was 1999, Phil Gramm, Republicans, but signed by Democrats, so both sides are guilty, basically deregulated this completely. And so what it does, just to use the fire insurance analogy, is instead of being able to get just fire insurance on my own home, I can get fire insurance on anybody else's home I want to as well, right? So I happen to know Sean's a pyro, right? And likes to play with stuff, that explodes or whatever. I can take fire insurance out on him. And we now have, I think, $60 trillion worth of these derivatives. And the problem is the banks that wrote these derivatives, right? They write these derivatives and they say, yeah, we promise to pay you if this mortgage-backed security goes bad. We'll pay you out. They weren't required to actually have the assets to pay out if these things went bad. And I think that has a lot to do with the extend and pretend and not allowing these losses to go through. Because the Federal Reserve, at the end of the day, works for the banks. The banks have written a lot of these. Goldman Sachs, who wrote a lot of these, quickly became a bank, as things started to fall apart so that they could get the protection that a bank gets. And, so I think that's one of the reasons that mortgage-backed securities are being bought at $40 billion a month by the Fed and the rest, is to keep these credit default swaps from figuring. Same thing's happening in Greece, right? They continue to bail out Greece after bailout, because if they actually default on the debt, then they have to pay out these credit default swaps. And there isn't necessarily the money to do that. So things that should have been left to default aren't because of the Commodities Future Modernization Act.
Right, and we were talking at dinner beforehand. It's, a lot of us may not want to admit this, but if somebody defaults on you, you have no choice but to default on your debt, and it's going to, sooner or later, that's
a financial meltdown.
Right.
We're back in 2008, but probably worse. So on these REITs,
Thanks for the good news. And Bruce, too.
Yeah.
Thanks. All the books that Bruce tells me to read, I'm like, oh my gosh, why am I reading this thing, right?
I doubt that these REITs will have credit default swap components and stuff. Maybe there'll be other actors in the market that create an ETF that allows you to buy the REITs without really buying the REITs, and who knows what they'll invent on Wall Street. But
it's clear they're going to invent something, because look at what it's morphed into now. I can tell you that there's a room full of people that were at Invest Club, to hear Bruce speak, that left that room pretty deflated because they were counting on this wave to come. And they were counting on no one being able to keep up, and they were just waiting for their turn at the table, right?
Yeah.
And anybody there? Anybody was thinking that way? A few people, right? Okay. So this is,
that turn was 2008.
Right. It's the thing. Nobody likes to think they were a few years too late.
No.
So we roll with it, right? That's what we do as investors.
The great thing about real estate investing is that there are always deals, right? I mean, I had friends that were doing deals in 2007 and 2008. It wasn't a fun time, right? But there's always deals to be done, and there's always
so much of
strategies
it,
and stuff.
I still remember. So those of you that know Mike Cantu, he has a quote I always remember. He says, "Well, Sean, I was on a plane last week, and as I looked out the window, I looked at all the rooftops. I can't buy them all." And I thought, hey, really, he's right. There's too many out there.
Yeah.
This question has a few parts. So it says, current average foreclosure statewide 291. And this says, will foreclosure time frames decrease? And then what he's asking here is, does the robo-signing settlement influence the future average days? And part two, how will the California Homeowners Bill of Rights affect time frames? So I think it's all about the time frames. And A, does robo-signing play a good or bad role, or lengthen or shorten? And how about the California Homeowners Bill of Rights in your research?
Yeah, so we definitely, when the whole robo-signing thing was happening, we definitely saw time to foreclose come up. And this is part of the free stats on our website. You'll see it went up, and then it came back down, and then it's been trending back up a little bit. So it definitely increased a little bit from the robo-signing thing, mostly because Bank of America just said, we're going to stop for a while. And that's what caused most of that lengthening of time. Robo-signing, I don't really feel is a big issue here in California, right? You don't have to notarize a notice of default or a notice of trustee sale. You know, some people could take a little bit of issue with the signatures on them and stuff, but you know, the courts have continually held that MERS isn't an issue here, that you know, signature issues, that minor defects in the sale aren't an issue, and have continued to uphold sales. And so we've got a pretty strong you know, set of precedent here in California that I don't think it's ever going to be really an issue. But some of these banks act nationally. So, you know, even though the problem's really in Florida, it affects California. So you think we get some rollover. And the Attorney General settlement is just a joke. And, you know, I don't really think it's going to have much impact. When it was just a giveaway to the banks. And, you know, Attorney General setting aside years of the thing that like got me the most about that settlement is part of the deal there. If they're going to do a reduction for a homeowner and get these credits, one of the things that it gives the banks the ability to do is if, let's say, there needs to be a 30% haircut and there's a first and a second mortgage, right? So usually the second mortgage takes all the haircut and then the first takes what it's supposed to take. What they said, well, is that's not really fair. We should let each loan come down at 30%, and that kind of got written in as part of the settlement. Well, guess who owns all the seconds? The banks. Right? So the Attorney General settlement was just a bank giveaway. Right. And even the $25 billion, remember, my clients are buying $500 million to $1 billion worth of foreclosures a month, and they're all complaining there aren't very many. $25 billion when you got a $2 or $3 trillion problem is just nothing. It was, and even there, it's a credit, you know, for them to recognize losses that already exist. The whole settlement's a joke.
How do you really feel about it? This one says, you've mentioned several times that the shift in policy included when TARP came out took away incentive for banks to foreclose.
Yep.
While the decline in foreclosure sales is obvious, why has this number not approached zero asymptomatically if there truly is zero incentive?
So we invented a term for that a while ago that we call foreclosure roulette, which is, keep in mind, right, we have 400,000 people not making their payments, but we got another 1.6 million that are underwater and they're still making their payment. And policy needs to be very, very careful to keep those people scared so they keep making their payment. So we randomly have to shoot one of their friends that isn't making their payment each month.
Spin it and shoot it, huh?
Yep. And if you happen to have equity, right? One of our clients called me and said, geez, the saddest thing happened today. He goes, I rolled up to look at a house that was going to sale and there was a bunch of people. It's kind of what was going on. And it was a wake. And the wife had died, and then the husband died like almost immediately afterwards. And so they're literally holding the wake at the house. And in all this medical turmoil, right, the payments weren't getting made, and the kids didn't know. And our client rolled up on this house, and you know, he actually met the kids and talked to them and said, you know, your parents' house is going to foreclosure sale today. And it sold in the minimum statutory time frame. Right? So the guy sitting in, there's a property in San Ramon that the guy paid $2 million for and has like a $1.8 million loan and hasn't made a payment in 5 years, isn't being foreclosed on. And the couple that had some medical trouble but has equity is foreclosed on immediately. And that's the kind of perverse incentives we've created with the changes in law that we have right now.
Kind of a Mad Hatter Tea Party too. You say foreclosure roulette, I say Mad Hatter Tea Party. Will mortgage debt forgiveness be extended for short sale sellers beyond December 2012? So get your crystal ball out and let's see what you think. I guess what's the incentive not to?
That may be the one thing that may be a little different depending on what president we get. I don't know. I don't think there'll be much difference when it comes to policy around this stuff. I haven't heard any cogent housing policy out of either party. But I think it'll be renewed.
All right. How long do you think the hedge funds will continue to buy these properties, and do you think they will exit the real estate market at some point in the future?
Yes, I do think this is a short-term window. There is a belief that real estate's undervalued. We have a zero interest rate environment, which the Fed says can last forever, and I don't think so. So I think at some point, a 5% returns for single-family rental homes doesn't make sense. If we stay in a zero interest rate environment forever, then maybe it goes to a 4, but I could be wrong on that. But no, I think that there's a window of opportunity here and that they're working very, very fast to take advantage of it because, a lot of, if you talk to hedge fund guys and private equity guys, they believe in a couple of things. And one of the things they believe in most is guns, golds, groceries, and JD, right? They all believe that, this financial thing that we have going right now is unsustainable and it's going to lead to massive inflation. And so most of these guys are playing hard and fast to buy their property in Utah that's, got some groceries and guns and gold stashed. Mm-hmm. So that's their mindset, right?
Right.
They could be completely wrong, but I don't, they're going to play the game as long as they can, and I think they see it as a musical chairs thing, and they're trying to move fast.
They're like the biggest predator right now out there as far as, so what do? A lot of this, like you said, a lot of your buyers are saying, well, hey, if I can take 3% off this big fish and wait them out and let them kind of lead the market, if you will.
Yeah.
When they exit, okay, eventually you say, eventually you're going to exit. When the window closes, great, but between now and then, do you capitalize on that window? Or do you fold your arms and say, I'm not playing with those guys?
Yeah, I mean, if you're a buy and hold investor, right, and we get this 5-cap bubble, and you're holding 100 doors, 50 doors, 10 doors, and they're willing to give you a 5-cap, right? So it went from 200,000 to 400,000 because you bought it at a 10-cap. I think that for buy and hold investors that plan to buy and hold a bunch of real estate and hold on to it for the rest of their life, you take advantage of that bubble right there. If it does hit a 5-cap, put a bunch of money in your pocket, wait for the whole thing to blow up and come back a couple of years later. So I think there's going to be real questions if they're successful, if it works, which I don't think is a complete given, right? I don't think it's absolutely certain that these guys are going to pull this off and get these things packaged up and sold at a 5-cap. But if they do, that might be a really interesting sales opportunity for the folks that thought they would hold real estate the rest of their life.
It died? You sounded really good. You have like a microphone voice, man.
I'll project if needed. Well, you need it for the stream, though.
Yeah, he's going to... Technical difficulties, just for a minute. Everybody give a hand to Ron, the AV. All right, thanks, Sean.
You need a second to turn it up.
Okay, we'll wait. We need to put one of those, 5, the target on the wall. Hold on a second. This one says, as
On that
I'm
one too,
stretching, yeah, let's let him finish
Yeah.
up on that one.
So on the other side, right, you're a buy and flip guy, and you buy something that's at a 10-cap, and current market value is only a 10-cap, right? Are you really going to sell that as a 10-cap if things are going to 7 and 5? So I think that those are, on every deal you do, ask yourself that yield question. Where is the yield on this? And if you're buying something that versus comps looks like a great deal, but boy, it's a 4-cap, and it's going to take you a year to get it cleaned up and sold, wait a second, is that 4-cap really, are those comps going to stay at that level? So, unless it's waterfront or something, I don't know that a 4-cap's reasonable. So just start thinking in terms of that cap rate or yield too as you look at your deals. And it may give you a chance to grab some extra on the deal if you're smart about that and keep your eye on this bigger bigger picture out there.
All right, this one says, do you have an Android app coming?
I will say that part of what we're releasing next year will be a lot more mobile.
Okay. Any chance bulk pool sales will stop or increase?
Structured deals like Fannie just did, make sense. There's a company called RentRange.com that's just, the guy was beating his head against the wall for a few years. I wish while he was beating his head against the wall, tried to buy him. I don't know he would have sold, but it would have been good. But he's just totally blown up. And what he's doing is he's selling rental data to the banks because the banks have realized this yield game's going on.
Right.
And instead of pricing their properties out at trustee sale or as short sales, you're getting a short sale that's declined right now. Take a look at yield. If it yields at a 10 cap, that's why it's declined. Right? Does that make sense? So if it's 10% return, and not all of them are this smart, but some of them are starting to get this smart. They're going, wait a second, I can sell that to a hedge fund at a 7 cap. Why am I going to sell it at current market value if that's a 10 cap?
Right.
So this company that sells these rental comps, rental AVMs, has just gone crazy in the last year.
Yeah.
And, so I think...
Because it comes down to how accurately can you gauge that number and how quickly can you get it to them so you can get in front of these funds.
So if they can sell out a bunch of stuff bulk at above market value, heck yeah, they're going to do that. So it's just going to come down to the particular assets and whether or not they're good rentals and that kind of thing.
This one says, what trend do you see with specified bios?
Specified bids.
Bids. Sorry, guess penmanship. I either read wrong or put a stick on it.
Auction.com's entry in the market has changed that a bit. I don't know.
You don't see a trend there?
It's increased with them, but I don't know how much more I can add to that.
Okay. This one says, how are foreclosures being determined of what type? Loan amount goes first?
Or
Maybe I don't understand the question.
clarifying out in the audience, maybe?
Equity first?
Yeah, I think if the bank holds the second, they don't want to foreclose on the first, right? Might as well sit on that sucker. It's somebody else's loss, not theirs. And we've seen that in the data repeatedly. And then if the losses are larger or the higher dollar loans, because things that were above, 7 whatever, right? The larger loans, those tend to be bank portfolio loans. So the banks are way better off leaving those. That's the guy in San Ramon with $1.5 million loan getting to live there free for 5 years. That's a bank portfolio loan. Last thing they want to do is foreclose on that because it affects their solvency. So those would be the biggest things. And then if there's equity and they're going to get a full recovery, sure, let's foreclose on that more quickly. So, I think those are kind of the big three that we've spotted so far.
Carjack neighborhood, like you said? Or?
Yeah, absolutely. They've clearly foreclosed faster in Riverside than in Orange County, right, as a percentage of delinquent homes. Or in Detroit, faster. They're small loans. They can get them turned through quickly. Those people aren't worth trying to work with. So, let's get those out of the system faster.
I'll close with the final question. So we are an investment club.
Yeah.
So if Sean O'Toole was trying to figure out where to put his money in real estate today, can you tell us what 1 or 2 asset classes or strategies Sean would focus on?
Yeah, so my real conundrum is I like trustee sales. I'm a trustee sale buyer. I like doing the title
Anybody else
research
out there really like that? Raise your hand. You got some kindred spirits out there with you.
So it's not for everybody, right? I'm an engineer by background, and I like uncovering title issues or finding lot line issues or other things that create kind of hidden value. And So from a research standpoint and just showing up and not having to talk to anyone, I like trusty sales. Other people are good at talking to folks and like it.
Fair enough. There's a lot of engineers that come to this group and watch it online, and that's a fair statement. So.
And I have capital, so trusty sales, and I'm not that risk adverse, so trusty sales work well for me. The problem is that all of my customers are trusty sales, and I can't compete with them. So I've been kind of locked out of that. But I saw a lot of people, back even when I was buying, starting to go, oh, California doesn't make sense. We're going to Texas. We're going to whatever. I started off when I first started buying with a 4-hour rule. I would drive 4 hours from my house and no further, and then that turned into a 3-hour rule. Then that turned into a 2-hour rule, and now I guarantee you it's no more than a 1-hour rule.
Okay.
So I think that there's deals, anywhere, and it kills me the guys that go buy in Texas and haven't knocked on their next door neighbor's door and somebody buys it for pennies on the dollar, and you hear those stories all the time. So I would stay as local as possible. And then I would look for 2 other things in particular. Obviously, I pay a lot of attention to yield, right? I want to buy a decent yield, certainly above the 7 mark and preferably above the 10 mark. And then I would look to economic activity, right? There's no way you fix Detroit except with a bulldozer, right? I mean, you've had massive net migration. That industry died, and a lot of people left. And you got a lot of old inventory, and there just isn't the population to support it. And trying to keep these homes erect or whatever is retarded. They just need to start saying, hey, you folks, we're going to give you these foreclosures over here, and you're going to move out of this neighborhood, and we're going to turn it into a park. And that's the only thing that's going to fix Detroit. And so you think about local areas. Where are areas of economic strength versus economic weakness? What areas have good long-term prospects versus no long-term prospects? And so I would look for a combination of decent yield and decent long-term prospects.
Fantastic. We certainly appreciate you spending your evening with us.
Thanks.
I learned a whole lot. Hopefully everybody else out there learned a whole lot. You guys can look at the archive of this video. It'll be up, as soon as we can, as soon as our audiovisual guys get that done. And then, of course, we'll have the audio stream so you can listen to it while you're driving. Please don't watch the video while you're driving. I don't have to tell you that. Especially in California, if they're going to get you for texting while driving, they're seriously going to hammer you for watching the video stream while driving. So, again, thank you, Sean O'Toole, Foreclosure Radar.
Thank you.
Thanks, everybody. What? Larry and Janet. We wanted to thank you guys again. And who have we got coming up next month? We don't know. It's Investors Workshops Roulette next month. It's a surprise. Yeah, exactly. So again, we appreciate you guys. Try to make sure you get your membership card, and we'll have some stuff. I'm going to make a promise we'll have something new next year too, because Sean's having something new, so I have to have something new. All right, we're going to do the meeting after the meeting, which is in the lounge right over here. Hopefully you guys can come over there. Take some time to introduce yourselves to some people. You might find your next partner in the room. Hold on, Phil's got something. Okay.
All right, everybody.
Hold on.
Next month is Halloween.
All right.
Next month is Halloween. We're
Surprise.
meeting before. We're not meeting on Halloween. Don't show up here.
Don't be here at Halloween.
Oh.
Although Jim had a great idea. Look at Jim Tusco. Raise your hand. He wanted to shave his son's head and come as Dr. Evil and Mini-Me. What a cool idea. All right. We're going to be early next month. We look forward to seeing you. Go make some money and make some deals. Thanks.
Are you here with me? Just looking out on the day of another dream, where you can't get what you want